Political economies are not experienced first through spreadsheets or statistical releases. They are experienced through language. Long before voters encounter charts on wage growth or inflation, they encounter claims, confident, repetitive, declarative claims about how well the economy is supposedly doing. Prosperity, in modern politics, is as much a rhetorical construction as an empirical condition. When Donald Trump praises an economic boom, he is participating in a long-standing political tradition, converting selective indicators into an all-encompassing story of success. Stock market highs become proxies for national well-being. Headline job numbers are treated as proof of universal opportunity. Growth rates, detached from distributional context, are invoked as moral vindication. The economy becomes a slogan rather than a system. This rhetoric works because it exploits a basic asymmetry. Macroeconomic data is complex, lagging, and often contradictory. Political messaging is simple, immediate, and emotionally legible. Best economy ever is easier to process than a nuanced discussion of real wage stagnation, rising household costs, or uneven regional growth. As a result, confidence can be asserted even when consensus is absent. But rhetorical prosperity also relies on a subtle redefinition of what counts as success. If markets are strong, discomfort elsewhere can be dismissed as anecdotal or psychological. If unemployment is low, underemployment and job quality are quietly ignored. Economic critique is reframed as pessimism, ingratitude, or partisan hostility, rather than as an argument grounded in data. The phrase "meh economy" captures the tension between official optimism and public ambivalence. It signals not collapse, but dissonance, the sense that something does not add up. When leaders insist on exuberance, while many households experience fragility, rhetoric begins to strain against reality. Over time, this gap matters, not because citizens expect perfection, but because they expect honesty about trade-offs, limits, and unresolved weaknesses. Economic language does not merely describe conditions. It shapes expectations and policy priorities. When prosperity is overstated, problems are postponed. And when rhetoric runs too far ahead of lived experience, trust becomes the first casualty. Stripped of slogans and superlatives, the economic record during the period Trump describes as a boom presents a far more mixed picture. The data does not tell a story of collapse, but neither does it sustain the claim of extraordinary prosperity. Instead, it points to an economy performing adequately by historical standards while carrying unresolved structural weaknesses that blunt its impact on everyday life. Growth rates, while positive, largely followed trajectories established before Trump took office. GDP expansion remained moderate, not transformative, and showed no sustained acceleration that would mark a true break from the post-Great Recession norm. Employment figures did improve, with unemployment falling to low levels. But much of this trend predated the administration and reflected long-term labor market recovery rather than a sudden policy-driven surge. Wages tell a similarly cautious story. Nominal wages rose, but real wage growth, after accounting for inflation, was uneven and modest for large segments of the workforce. Gains were strongest at the lower end of the wage distribution early on, then slowed as inflationary pressures began to erode purchasing power. For many households, higher paychecks did not translate into a meaningful improvement in living standards once housing, health care, and child care costs were factored in. Labor force participation, often overlooked in celebratory narratives, remained below pre-2008 levels, especially among prime-age men. This suggests that headline employment numbers masked a thinner labor market than unemployment rates alone implied. Productivity growth, the key driver of long-term prosperity, also remains subdued, limiting the economy's capacity to generate sustained wage gains. Inflation, which stayed relatively muted early on, later surged, further complicating claims of widespread economic comfort. Rising prices exposed how fragile earlier gains had been, particularly for middle and lower income households with little buffer against cost increases. Taken together, the data describe an economy that was functioning, not flourishing. It was stable enough to generate favorable headlines, yet insufficiently dynamic to deliver the broad-based sense of progress implied by political praise. The numbers, read carefully, explain why many Americans responded to talk of a boom with indifference rather than enthusiasm. Economic statistics measure outcomes in aggregate. People experience the economy individually. The gap between those two perspectives explains why an economy that appears healthy on paper can feel distinctly underwhelming in daily life. For many Americans, the question has never been whether the economy is technically growing, but whether that growth alters the pressures that define their routines. Household experience is shaped less by GDP or stock indexes than by rent checks, grocery bills, medical copays, and the fragility of employment. During the period described as an economic boom, these costs continued to rise faster than incomes for wide segments of the population. Housing, in particular, became a source of persistent strain, with prices and rents climbing well beyond wage growth in many regions. For those outside asset-owning classes, market gains registered as distant abstractions rather than personal benefits. Job quantity also diverged from job quality. Low unemployment masked the prevalence of insecure work, limited benefits, and unpredictable schedules. Many workers were employed, yet felt economically exposed, one illness, one layoff, or one unexpected expense away from crisis. This insecurity does not register in headline labor statistics, but it dominates economic perception. Psychology further complicates the picture. When leaders repeatedly declare prosperity, individuals who feel financially stagnant may conclude not that the narrative is wrong, but that they themselves are falling behind. Economic dissatisfaction is then internalized as personal failure rather than recognized as a systemic outcome. This dynamic deepens alienation and erodes trust in official messaging. Regional variation amplifies this divide. Growth clustered in certain metropolitan areas and industries, while smaller cities and rural regions saw little change. National averages concealed local stagnation, reinforcing the sense that the celebrated economy existed somewhere else. The Maconomy label captures this disjunction precisely. It is not a cry of distress, but an expression of unresolved tension between data and daily life. When economic success is proclaimed but not felt, perception becomes a counter-indicator, signaling that something essential is missing from the story policymakers tell themselves and the public. Economic narratives often assign authorship, where continuity is the more accurate explanation. Presidential rhetoric, however, rarely tolerates patience with history. Claims of sudden transformation depend on ignoring the inertia built into large, mature economies. Growth, employment, and investment respond slowly, shaped by decisions made years earlier and by forces no single administration can quickly redirect. Much of the economic improvement celebrated during Trump's presidency reflected trends already in motion. The long recovery from the Great Recession had been underway for nearly a decade, characterized by steady job creation, gradual declines in unemployment, and modest growth. By the time Trump took office, the economy was operating close to full employment, leaving limited room for dramatic acceleration. What followed was continuation more than rupture. Tax cuts and deregulation were presented as catalytic interventions, yet their effects were uneven and often temporary. Corporate profits and stock prices responded quickly, but business investment did not surge in a way that reshaped productivity or wages. Share buybacks absorbed a significant share of corporate tax savings, reinforcing asset values rather than expanding capacity. The benefits were real, but concentrated. Misattributed credit thrives on short time horizons. Positive indicators are claimed as proof of policy genius. Negative ones are blamed on external shocks or inherited problems. This asymmetry distorts public understanding of how economies actually function. It encourages the belief that leadership alone can override structural constraints, business cycles, and demographic realities. The danger of this simplification is not merely analytical. When continuity is denied, policy evaluation becomes theatrical rather than empirical. Success is measured by applause lines instead of by whether underlying vulnerabilities have been reduced. Long-term challenges, stagnant productivity, rising inequality, aging infrastructure are overshadowed by quarterly metrics and market reactions. The legacy effect also obscures responsibility. If every gain is self-made, there is little incentive to preserve what preceded it or to acknowledge institutional foundations built over time. Economic stewardship becomes performative rather than cumulative. Understanding the economy requires resisting the temptation to personalize trends that are fundamentally systemic. Without that restraint, public debate devolves into credit-claiming contests that explain little and prepare the ground for disappointment when inherited momentum inevitably fades. Aggregate growth can rise while social cohesion quietly thins. This is the central blind spot of triumphalist economic narratives. They treat expansion as inherently democratic, assuming that gains diffuse naturally through the population. Yet the American economy of this period demonstrated how growth can coexist with widening disparities and a shrinking sense of shared progress. Income and wealth inequality were not new developments, but they intensified the disconnect between headline success and everyday experience. Asset appreciation disproportionately benefited households already positioned to invest, while wage earners without savings or property saw fewer gains. The stock market's ascent, so often cited as evidence of prosperity, accrued mainly to the top segment of the income distribution. For the middle, it was largely symbolic. The tax and regulatory environment further tilted outcomes. High-income earners and corporations captured the most durable benefits of policy changes, while temporary relief for others faded quickly. The promise that these advantages would trickle down through investment and job creation proved limited, reinforcing skepticism toward familiar economic claims. The middle class, long treated as the moral center of American economic life, found itself increasingly squeezed. Earnings growth failed to keep pace with rising costs, while job security weakened. Upward mobility became more conditional, tied to geography, education, and access to networks, rather than effort alone. This erosion does not announce itself dramatically. It accumulates quietly through deferred milestones and narrowing options. Distributional neglect has political consequences. When economic success is framed without regard to who benefits, discontent is easily dismissed as ingratitude or cultural resentment. But dissatisfaction rooted in material imbalance does not dissolve under rhetorical pressure. It hardens. The missing middle is not an abstract concept. It is visible in consumption patterns, debt reliance, and declining confidence about the future. An economy that grows without restoring the middle's security may appear strong, but it lacks resilience. Over time, inequality becomes not just a social issue, but an economic one, undermining demand, trust, and the credibility of claims that prosperity is broadly shared. Economic narratives do not circulate in a vacuum. They are amplified, filtered, and stabilized by institutions with their own incentives, none more influential than financial markets and political media. Together, they form a feedback loop in which selective truths are rewarded, inconvenient data is sidelined, and confidence becomes self-reinforcing even when its foundations are uneven. Markets respond quickly to signals that favor liquidity, profitability, and regulatory advantage. Rising equity prices during this period were interpreted not merely as reflections of corporate performance, but as endorsements of leadership itself. Market optimism was folded into political validation, despite the fact that asset prices often anticipate future conditions rather than describe present welfare. Volatility, risk concentration, and speculative behavior were largely overshadowed by index levels. Media ecosystems, increasingly segmented by ideology, reinforce this simplification. Favorable indicators were elevated to headline status, while contradictory data were framed as noise or dismissed as partisan skepticism. Complex economic realities were reduced to scorecards, jobs up or down, markets green or red, encouraging binary judgments in place of sustained analysis. In this environment, nuance struggled to survive. Selective truth thrives on repetition. When markets rise and leaders proclaim success, each reinforces the other's authority. Dissenting interpretations are portrayed as disloyal or pessimistic, narrowing the space for honest evaluation. Economic debate becomes less about understanding conditions than about affirming identity. This dynamic carries costs. Policymakers insulated by market applause may underestimate vulnerabilities building beneath the surface. Media outlets, chasing attention and alignment, may prioritize affirmation over interrogation. The public, confronted with confident narratives that conflict with lived experience, grows skeptical not just of specific claims, but of expertise itself. The politics of selective truth does not require falsehood. It requires emphasis without proportion. By spotlighting favorable signals and minimizing structural concerns, it constructs an economy that appears stronger than it feels. Over time, this imbalance corrodes trust, leaving citizens unsure whether economic communication is meant to inform or to persuade. When that doubt sets in, even accurate warnings struggle to regain credibility. The ultimate cost of overstating economic success is not analytical error, but policy blindness. When an economy that feels mediocre to many is proclaimed a triumph, the space for corrective action narrows. Problems that require attention are reclassified as misunderstandings. Structural weaknesses are treated as political nuisances rather than economic facts. Satisfaction, declared prematurely, becomes a substitute for stewardship. Calling a meh economy a boom reshapes priorities. If prosperity is assumed, urgency dissipates. Investments in productivity, infrastructure, workforce development, and cost containment lose political appeal. Why fix what has already been declared fixed? The result is not stasis, but drift an economy moving forward without addressing the frictions slowing it down. There is also a civic cost. Public trust depends not on optimism, but on credibility. When official narratives diverge too sharply from lived experience, citizens conclude that economic language serves power more than truth. This skepticism does not remain confined to economic claims. It spills into attitudes toward institutions, data, and expertise more broadly. Over time, the shared factual ground necessary for democratic debate erodes. Mislabeling mediocrity as excellence also distorts accountability. Leaders who claim sweeping success are less prepared to explain setbacks, more inclined to externalize blame, and more likely to respond defensively when conditions worsen. This posture weakens resilience. Economies, like democracies, require adaptability, which begins with an honest diagnosis. The irony of the meh economy is that it describes an economy capable of doing better. Stability existed. Collapse was not imminent, but potential was constrained by uneven distribution, rising costs, and modest productivity. Recognizing those limits would have invited improvement. Denying them postponed it. In the end, economic strength is not measured by applause lines or market highs, but by whether growth translates into security, opportunity, and confidence for the broad population. When rhetoric outruns reality, the reckoning is delayed, not avoided. And when it arrives, It is often harsher for having been ignored.